Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AAON INC quarterly report. AAON Inc. offers a wide range of businesses and services including engineering, manufacturing, marketing, selling air conditioning and heating equipment, rooftop units, data center cooling solutions, cleanroom systems, chillers, packaged outdoor mechanical rooms, air handling units, makeup air units, energy recovery units, condensing units, geothermal/water source, heat pumps, coils, controls. The company serves various industries such as retail, manufacturing, education, lodging, supermarkets, data centers, medical and pharmaceutical, and other commercial sectors. AAON Inc.'s stock price decline. A multifaceted analysis the past year has seen a general decline in AAON Inc.'s stock price, with a 3.6% decrease as of October 24, 2025. While no single event caused the significant drop of over -15.67%, several developments have contributed to this trend. AAON's first quarter earnings, not meeting analyst expectations on April 25, 2025, led to a 2.5% decline in shares. Additionally, mixed analyst activity, including reduced quarterly earnings forecasts and lowered price targets, weakened the stock performance. These factors collectively contributed to AAON's stock trading lower throughout the year. The lack of a singular event causing the significant drop suggests that the decline is a result of cumulative effects from these various developments. As such, it is essential for investors to consider multiple factors when assessing the company's performance and future prospects. The primary drivers of revenue growth or decline are largely influenced by external factors, internal operational changes, and market conditions. On the growth side, increased sales to affiliates, strong production at AAON Oklahoma, and growing demand for data center solutions have contributed to revenue expansion. Additionally, strategic inventory purchases by customers have also boosted sales. However, several challenges have led to revenue decline. Tariffs and trade policies have had a negative impact, while increased raw material prices and softer rooftop markets have further exacerbated the issue. Supply chain constraints caused by refrigerant changes and coil supply shortages at AAON Oklahoma have also hindered growth. Furthermore, disruptions from ERP implementation have affected production and profitability. In summary, revenue growth is driven by strategic sales, strong production, and growing demand, while decline is attributed to external factors such as tariffs, internal operational challenges like supply chain constraints and ERP implementation issues, and market conditions like softer rooftop markets. The financial performance of a company has taken a significant hit over the past period. Net income plummeted by 47.6%, decreasing from $143,869,000 to $75,561,000. This drastic decline can be attributed to various factors that have impacted profit margins. Gross profit margin and operating profit margin both saw a substantial decrease, dropping from 35.4% to 27.1% and 19.9% to 10%, respectively. The primary reasons behind this downturn are inflationary cost pressures, the COVID-19 pandemic's effects on demand for products and supply chain disruptions, as well as fluctuations in the commercial/industrial new construction market. These external factors have cumulatively contributed to a significant decline in profit margins, resulting in a substantial decrease in net income. The company's financial performance indicates a fluctuation in its ability to generate positive operating cash flow. In 2024, the company achieved a significant positive operating cash flow of $191,687. However, this trend reversed in 2025, resulting in a negative operating cash flow of -$18,784. This shift suggests that the company's financial health is not consistent and requires further analysis to understand the underlying causes. The company's debt level has seen a substantial increase over the past year. The outstanding debt as of September 30, 2025 was $499.3 million, a significant jump from $76.8 million at the end of 2024. This growth is attributed to increased borrowings and higher interest expenses. Net interest expenses rose from -$1,697 in 2024 to -$11,964 in 2025, indicating a substantial increase in debt-related costs. Management is expressing cautious optimism about the company's outlook and strategy. Despite potential negative impacts from trade conflicts, supply chain challenges, and a tight labor market, management believes that the company has sufficient cash reserves to meet its needs. They are preparing for these challenges by passing on costs to customers and making strategic purchases of materials. The company is also investing in future growth through a $180 million capital expenditure program. Overall, management is confident in the company's ability to navigate current challenges and access capital markets as needed. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has paid dividends to stockholders in both 2024 and 2025, totaling $24.4 million and $19.6 million respectively. Secondly, the company has implemented a share buyback program with authorized amounts of $50 million and $100 million, indicating its willingness to repurchase shares and enhance shareholder value. Concerns about inventory buildup and supply chain disruption. The financial summary highlights several red flags regarding inventory buildup and supply chain disruption. On page 11, macroeconomic conditions and tariffs may impact inventory valuation and reserves. Page 12 warns of manufacturing part shortages due to trade conflicts. A significant increase in raw materials inventory, 33%, and allowance for excess and obsolete inventories, 20%, on page 18 further exacerbates these concerns. The potential for increased costs due to tariffs, uncertainty in raw material prices, supply chain challenges, and trade conflict is also mentioned on page 40. Additionally, supply chain constraints caused by refrigerant changes and ERP implementation have disrupted production on page 41. AAON Oklahoma's net sales decreased by 11.9% due to supply chain issues from the refrigerant transition and coil supply shortages in the second quarter, on page 44. The company's historical trend of increasing inventory purchases to mitigate future supply chain disruptions is also noted on page 49, indicating a potential ongoing issue with inventory buildup or supply chain disruption. That concludes the financial summary for AAON INC. Feel free to comment below, and I will be happy to answer them when possible.